Hello, and welcome to the Red Shoe Realty podcast. My name is Stacey Sappington, and I'm the broker owner of Red Shoe Realty. And this podcast and this brokerage are built for the agent to give you the tools and the knowledge you need to succeed in this business. And today I am so excited because I'm chatting with my friend and colleague, Kelly Dooley with Supreme Lending. Welcome, Kelly.
Hey, good morning, Stacey.
Good morning. Before we get started, tell us a little bit about you and who you are.
Oh, awesome. Well, yes, it's awesome to be here. I'm with Supreme Lending, yes. So our corporate office is actually based in Dallas, and that's the branch I represent. They're in Dallas as well, but I do work from home like a lot of us here in Spring. So I'm local, I'm right here, and I'm always out and about, always meeting clients and agents for coffee or whatever they want, but I am right here in Spring. And again, yes, I'm with Supreme Lending.
Awesome. You're right around the corner from me.
Yes, ma'am.
So today our topic is down payment. You know, we have so many different programs and so many different things, and things change all the time. And so I'm so excited that I get to have you, the expert, talk about that and all of the different moving parts. So I'm just going to turn it over to you and let you run with it.
All right, sounds good, Stacey. So thank you so much. Yeah, down payments is a huge topic, especially when buying a house, because there are several loan programs, which many people have heard, but they just kind of maybe want to know how much do I need for each loan program. So I'm going to start with conventional. Everybody has heard of a conventional loan, and quite honestly, there are two down payment amounts for a conventional loan. One is 3%. Not many people have heard of that before. The most common down payment for a conventional loan is 5%, but there is a conventional loan that we offer. It's 3% down. It's an attractive loan and down payment because it's less than the FHA, and I'll get into that in a second. This 3% program is for first-time buyers, and or the other qualification is 3 years removed from owning a home. Okay, so there is that loan program. Then also, like I said, there is the 5% down conventional loan, which is the most common type. Now, somewhat you need to remember, for a conventional loan, you know, your credit score does come into play. Okay, everybody knows credit, you have to have good credit, etc. Well, a conventional loan, typically you need around a 680 to get a decent interest rate for a conventional loan. I didn't say you're not going to get approved. I just said your rate might be quite a bit higher if your FICO score is below that 680 threshold. So then sometimes it might be better to go FHA. Now I always weigh those options for my clients. Okay. Now staying on conventional loans, there's that common misconception that I have to put 20% down. I heard that so many times last year. The answer to that is no, you don't need 20%. That kind of freaks people out when they're like, oh my gosh, 20% of 300,000, you know.
Yeah.
So the only reason to do 20% down is to get rid of the mortgage insurance. Okay. Mortgage insurance is it's that thing that's already built in your payment. Okay, and it's based on credit score, debt to income ratio, loan type, amount down. And I have zero control of what the mortgage insurance is going to be for the buyer. When it comes to that part, and you do put less than 20% down, I go to a screen on the software that I use, and there are 6 carriers of mortgage insurance for the whole country. And I hit a button, and I basically hit the cheapest option for the buyer. Okay. Mortgage insurance on average is anywhere from $50 to almost $200. Again, based on your credit, debt to income ratio, that kind of stuff. So, and it's already built in the payment. Like I said, when you make a mortgage payment, let's say it's $2,000, well, your mortgage insurance is already built into that. Okay. How does it go away? I'm glad you asked. So it goes away if you're in a conventional loan once your house hits 20% equity. Okay. That's the big difference between conventional and FHA. On a conventional loan, the mortgage insurance will go away eventually. And on average, the home values have been increasing rapidly the last couple of years, right? How fast does that happen? Well, 3 to 5 years, maybe a little, depends where you buy and how the values are going up. So just to recap, conventional loan, 3% down or 5%. And if you have the 20% and you want to get rid of the mortgage insurance, great. But here's one more thing, Stacey, on conventional loans. I do this all the time for my buyers. If they have the 20%, but it's kind of a stretch to put that down, I can look at doing 10% down or 15% and tell them, look, if you do 10% down and you've got good credit, your mortgage insurance, I can already tell you, is only going to be about $30. So they'd rather hold on to that other 10% and gladly pay the $30 additional inside their payment. Right. So there's that option too. I always, look at the best case scenario for the buyers.
Yeah. And what the trade-off is. Yeah, that does make a lot of sense. And it's comforting to know that you do look at that to see what is the best option.
Right. Why stretch yourself to put 20% down? It's only going to be, you do 15%, save $8,000-9,000 for $30 a month. It's going to go away anyway in like a year or two. Right. So I always do that for my buyers. So that's conventional loans. Okay?
Can I ask one question before?
Oh, yeah.
So when it comes to the 3% versus the 5%, you said that the dictator on that was that I have to have not owned a home for the past 3 years.
Correct.
Is that the only qualifier between the 3% and the 5%?
That is correct. That's first time buyer, 3 years removed from owning a home. It's an attractive loan for those people that want that conventional loan. Like I said, that mortgage insurance will eventually go away. Right. And they have that 3% and their credit's pretty good. I do that a lot for people.
Okay, yes, cool. Yeah.
Okay, so FHA loan. Okay, that's really the most common first-time home buyer loan program. Why? Because it's low amount down, so it's 3.5% down. And for those of you who don't know, and I need to maybe emphasize this. What do I mean by down? It's you take the price of the house, $200,000 times 3.5%, or the conventional loan 5 or 3%. You multiply that, right? That's your down payment. FHA is very popular because it's more flexible when it comes to credit score. Your credit doesn't have to be as stellar. We can go down to a 620 for what's called an automatic approval or underwriter. So that's number one. Number two is, I think I heard, or I said the debt to income ratio, or DTI. That's really that determines how much house you can afford. Well, on a FHA loan, it's more flexible. So we can go up to 57%. So you can have a little bit more debt, right, and buy a house. Whereas conventional, and maybe should have said that, is only 50%. It's a little more strict. Okay.
So credit wise and debt to income.
Exactly.
Conventional is more strict. Okay.
Right. So that's why a lot of people will tend, especially that first house, I can have a little more debt. My credit's not as great. So I can, buy that FHA house. Yeah. And I'll tell them, look, just because you're buying an FHA house, it's not the end of the world, because they freak out about the mortgage insurance. What I typically do is, after a year or two of having that FHA loan, and they want to stay in that house, we will refi them into the conventional loan. Mm-hmm. Happens all the time, because they know that MI is going to go away eventually out of a conventional loan. Right. So, and when you refi, there's no out-of-pocket costs other than an appraisal. Sometimes that can get waived. That's a whole other thing. So I'll tell people that, hey, let's get you this FHA loan, even though they may have the 5%. Okay, I've done this a lot. They may have that 5% for a conventional loan, but their credit score is a 640. And I'll show them it's cheaper, it's more cost effective to get in the FHA loan. Because of the rate. Because their monthly payment is, it's significant, like $300 difference. Yeah. And they appreciate that, and me educating them. Here's why we should go FHA versus conventional, even though they may have the money. Does that make sense?
It does. And I love that you use the word educate, because I feel like that's our job, from the agent side and from the lender side, because people have no idea, even if they have bought a home before, they don't remember, and
Right.
I think that's our number one role, is to educate buyers.
Yeah, because they put a lot of trust in the agents and myself, and we're looking after their best interests. So that's why a lot of agents, a lot of clients have repeat clients, because I do educate them. I show them on real numbers. Here's what we're looking at.
Yeah.
So yeah, FHA is a great program, and I always recommend it if we can. The lower the credit score. Now, I did say 620. We can go to a 580 on credit scores, but what happens is that debt to income ratio that I mentioned, it shrinks quite a bit. Okay, it's more strict, and it's called a manual underwrite. I mean, we have a checklist we have to go through. It might require more paperwork and maybe more income statements. So it can be done. I just approved someone the other day with a 583. It wasn't easy, but we got it done for them. So really the main thing on this FHA is have that 620 credit score. That's something, people can kind of strive for.
Yeah.
And I really should have said this too, Stacey. When you buy a house, whether it's FHA or conventional and these other loan programs I'll cover, it's broken into two halves, or two cost figures: the down payment, then the closing costs. Okay, everyone's probably heard of the term closing costs. Well, you got the down payment part and the closing costs. People always ask me, well, how much is that? How much are the closing costs? Well, the closing costs are the title company and what they charge to have your closing, their fees. The lender, myself, what do we charge to originate the loan? And it's really kind of setting up of your escrow account for the taxes and insurance of the house. Depending on where you buy, again, on average, I would say closing costs can be anywhere from $6,000 to $8,000, depending on where you buy again. So that's closing costs. You put those two figures together, that's how much it costs to buy a house. So I just want to make sure everybody, know the term closing costs.
Yeah.
So that's FHA. Okay, now VA. A lot of people have heard the VA loan. Well, VA is for military personnel that have served in our military or currently serving in our military. The VA has an attractive loan for them. It's zero down, so meaning nothing down. Like FHA is 3.5% down. VA is zero down, but they have to still cover closing costs. So that 6,000 to 8,000, whatever that might be. So agents, to make them come across as the expert in the field when it comes to a VA buyer or client, first thing they should ask, and this is important, is what do you have your DD 214? Everybody in the military, if they're going to be interested in a VA loan, they know what a DD 214 is, like a driver's license. Have your agents ask, hey, get your DD 214, send it to the lender, because we have to have that to send to the VA to find out their eligibility. And that's usually done the same day. They're pretty quick to turn that around. So once we find out the eligibility, it's the rest of it's just like an FHA or a conventional loan. We just get the application filled out, figure out income, that kind of stuff. So VA is zero down, but just covering closing costs, and DD 214. Okay. Then there's the final loan program is USDA. They're not as common, especially in the city or even the suburbs. USDA is more of an agricultural loan, like for farms on some acreage, that kind of deal. And it's important for people to know, and agents, it's really, to get a USDA loan, it's almost zoned. They're on the map. If you look at a map of the United States, there's only certain parts that will allow USDA loan. Okay, so if you get a buyer that's interested in a USDA loan, we really need to get the address first, just to make sure where that ranch is or where that house is that's even qualified for a USDA loan. But what's attractive for USDA loans is it's zero down like a VA loan, and you can roll the closing costs, that 8,000 roughly, into the loan. But the caveat for a USDA loan is really good credit. The buyer's got to have really good credit and minimal debt for them to be able to qualify for a USDA loan. We don't do a lot of them. I mean, I've done a couple here and there over the years. We just don't see them as often. So if you've got an agent that may have a lead or a buyer that's asking about USDA loan, the best advice I can give is just have them talk to me, and then we can kind of figure it out and get everybody on the same page.
Yeah.
So, but yeah, that's really the loan programs right there. And it's, again, your audience just needs to really to get a house or have a plan is to have a 620 credit score minimum, save up that down payment plus the closing costs. I always shoot for 8,000, and really kind of go from there. If they have more questions, we can always talk. But that's kind of it in a nutshell, Stacey.
Yeah, and that's really good information, especially for newer agents, because there are just so many programs out there. And we have a lot of things that we need on the agent side that we need to know and remember. And I think one of the greatest things about working with a lender that is so knowledgeable like yourself is to have you as that expert. So I don't have to be the expert on all the programs. I can just send the client over to you and know that you're going to educate them and help them figure out what's best for them. So that's comforting.
Absolutely. And yeah, you just surface level, for you guys, and say, hey, let's talk to Kelly, that kind of stuff. And for your agents to get someone approved for any one of these loan programs, it's filling out an online application, collecting the last 2 years W-2s, sometimes tax returns, but really just W-2s and last 2 pay stubs. Once they get the application to me and I get those W-2s and pay stubs, I can approve someone that day. If they get everything to me that day, it's like putting a puzzle together, and I can issue them an approval letter for the most part. So that's, I can do it for them. But I'm always call or text away. I answer calls and text the same day. I'm really anal when it comes to communication. You guys are out there hustling. I just want to make you look good.
And that's so important, especially with a lender, is the communication piece. So that goes a long way.
Yes, ma'am.
And, I've got, Kelly set me up with an app, and so he can do the same thing for you guys too. But the client can do the application right there on the app. And that's the world we live in these days. So it really makes things a lot easier and smoother for everyone.
Yep, absolutely. More and more people doing everything on their cell phones. So we're just trying to join the technology show there.
Yeah. Well, all of your information will be posted here at the bottom of the video. So I encourage you guys, reach out to Kelly. You'll be really glad that you did. He's a great person to connect with and just talk with. And Kelly, thank you so much for being a guest on the podcast.
Heck yeah, Stacey, it was fun. Love seeing you.
Yeah, you too. Okay, guys. Well, thanks for tuning in to this episode, and we will see you next time.
All right. Bye, everybody.